So yeah, we got a question from a client who says, what is Keystone's view of using Sprott Trust, example PHYS or PSLV, or equivalent to hold physical gold as a portion of one's overall portfolio? So both of these are closed-end mutual fund trusts. The first, Sprott Physical Gold Trust, PHYS on the TSX. There's also a US dollar version on the TSX, and I believe it also trades in the US as well. But the current price of the one on the TSX, just the PHYS in Canadian dollars, is $26.40, with about a $10.8 billion market cap and a management expense ratio of 0.41%. Now, the trust seeks to provide a secure, convenient, and exchange-traded investment alternative for investors interested in holding physical gold bullion without the inconvenience that is typical of direct investment in physical gold bullion. And the trust invests primarily in long-term holdings of unencumbered, fully allocated physical gold bullion, and it does not speculate with regard to short-term changes in gold prices, and the physical gold is held with the Canadian Mint or a custodian. And the other one here, Sprott Physical Silver Trust, or PSLV on the TSX, trading at $13.74 Canadian right now, with a $6.8 billion market cap and a management expense ratio of 0.6%. The Silver Trust is, essentially the same, but it invests primarily in long-term holdings of unencumbered, fully allocated physical silver bullion. And to answer Steve's question, generally, I do not think that either trust are a bad way to gain exposure to gold or silver, but a few things to note are, if you do plan to invest directly in gold or silver with these trusts, I would make sure that it is a smaller amount of your portfolio, perhaps, around 1 to 3%, as commodities are highly speculative and, in our opinion, can be quite volatile. We just don't know where they're going to go. Another point here is there are also some important concepts to understand, which make your returns different than what you may expect to receive if you held the physical commodity itself. So here's an example of a person on Reddit asking how they got screwed on his Sprott Gold Trust investment. So he says, I set aside $22,000 for my son's new car when he graduated college. When he got out, his mom put him in a pretty new truck, so we parked his $22,000 at Ameritrade, and he decided to buy PHYS on my recommendation. And just to make a quick comment here, first thing I would note is an issue with placing the full 22 grand in PHYS. This clearly goes against our strategy of diversification, and I would say is far too much exposure to a commodity in his son's portfolio. But anyways, that's just a side note. So to continue here, he says, we bought PHYS shares on October 14th, 2021. Looking at the chart of gold on Trading Economics, the gold price closed at $1,767 on October 11th, and it closed at $1,792 on October 18th. I could have sworn we bought his PHYS when gold was $1,787. So the 22,000 should be up 1.5%, but he's actually down about 0.14%. My God, that's $27 per ounce over a 2-year period. So what's happening here, essentially, he's asking. So let's look. Now, the trading price of the trust's units may become more volatile relative to the actual net asset value, or NAV, and could continue to be impacted by various factors which may be unrelated or disproportionate to the price of silver or gold, including things like market trends, as well as the sentiment of investors toward gold or silver. And as such, you can see here directly from Sprott, I have up on the screen, the market price return of the gold trust, its underlying net asset value, or NAV, and the Bloomberg spot price return of gold all differ. And if you purchase trust units at a premium to the NAV, you may incur losses if the factors that have contributed to the increase in premium to the NAV were to disappear. The opposite would also be true if you bought at a discount. So keep in mind that the actual return of gold may be different from your investment in the trust, given both the premium or discount of the trust's market price compared to the NAV. And as you can see, Since inception, the premium or discount to the net asset value has ranged from a premium of all the way up to 24% to a discount of 3.6%. So the market price may have been trading at a premium when this individual bought it, causing their actual return to be different from what the underlying commodity has actually done if that premium does disappear. And again, you can see over the past 10-year, 5-year, 3-year, 1-year, and 1-month period, the spot gold price return outperformed the actual return of the trust, with the one exception of the year-to-date period. On top of this, it's important to note that each trust has a management expense ratio, which will also eat into an investor's returns, as these are essentially the fees that you're paying. So while I do not think that it's a bad way to gain exposure to either gold or silver, and is certainly a more liquid way to gain exposure, given the ease of buying and selling in the open market, keep in mind the potential discount or premium that you will be paying over the net asset value and how it may impact your actual returns compared to the actual commodity. Today, if we look at PHYS in Canadian dollars, it's trading at a discount to the NAV of around 1%. And finally, I should also just add here, be aware of currency risk, as the net asset value of the trust is in US dollars. So if you are buying in Canadian dollars on the TSX, you will be exposed to currency risk as well. And yeah, that's my segment. Again, I don't think that, it's a bad place if you want exposure, but there's just some things that you have to be aware of, which I went over.
You did a good job of pointing out the risks there, which is great to see. And you pointed this out, one of the main things, I know it's not the main point you're making or the question comes from, but putting 20,000+ in one gold related asset, and we don't believe in mass diversification, but I mean, that is just, like we always say, 1 of 2 to 3 stocks in your portfolio. If you do that, even if you put all the research in, if you're just going to have 2 or 3, there's too much company specific, there's too much commodity specific risk here. And, not good practice to just be doing that in a portfolio. That kind of stuck out at that segment. I know it wasn't the point of the segment, but yeah, you see people doing that, and you just question.
There's no way if my son had 22 grand, I would be telling him to place it all into.
And what was the return over that? Was this a year period or what? How long was it?
Sorry, for basically, I believe it was a year period. Yes, a year period.
And do you know the return they gained there? It was
I think he said it was actually, they were down 0.14%.
So you would have been better off in just a GIC.
Yeah, this is true. Yeah. This is true.
Yeah, and that's the other thing. Not as well, not directly the point you're trying to make is, if you are looking at short-term things, don't be even, most of the time you don't even want to be looking at stocks or commodities or commodity ETFs. You want to just be looking at GICs. It's not even our specialty, and that's almost always what you want to do, because you're going to have those short-term, you're going to have the random walk-down Wall Street movement, you're going to have the, random walk-down Gold Street, and it could easily go down 30% a year. And if you were counting on that money, it's not there when you need it.
And this is coming from a group that loves growth, that loves taking risks, that loves, educated, obviously, risk to make long-term gains. But if it's a short-term, if you need that capital for a short-term goal or a short-term purchase that you have to make, you should not be investing in something like this. It's not that this is unto itself the most risky investment out there. It's just one investment. If it was one stock, even if it was, if you're putting that into a diversified S&P index fund, it's probably not good if you need it in 2 months or a year from now, if you need that capital.
No, and just a bit more further on the actual gold point is, you'll see a lot of things called online, very cherry-picked or time-sensitive data, where they'll say gold outperformed the S&P 500, but it'll be this specific date range. And because of the volatile nature of gold, where some periods it's been up 100%, then it goes down by 50%, and it stays there for 5, 6, 10 years, or whatever it happens to be. And then they'll quote, if you bought during this time period till now, it outperformed the S&P 500. But then it just conveniently cuts out, if you bought out 1 year earlier, you would have performed drastically worse. So you really need to be careful when you're looking at gold, especially. I find it's quoted and graphs are shown where the data doesn't always reflect the reality, the volatile nature when you're especially looking at those total return graphs, as well as the quote indexes versus, like, if you want Sprott here, you're paying 0.4% management fee every year, which does, when you're looking at a relatively low returning asset over time, that actually does add up. And especially then further, you have the premium and or discount ratio, like Brennan was focusing on for the short term.